Good afternoon, everyone. Thank you for coming. I'm delighted to be here and delighted to have you all here. So 15 years ago it was that we had the first Bitcoin transaction in 2009. At that time, the paper that launched Bitcoin said the goal was a peer-to-peer version of electronic cash, so people could send money directly to one another without financial intermediaries. Okay, so we'll eventually call that real-time gross settlement. It means you just send one payment from one person to another without anyone in the middle. So that was the dream 15 years ago. If we look forward to what's happened today, look back now from 2024 over the past 15 years, payment systems have actually greatly improved. When I mean greatly improved, I'll talk about in terms of speed, convenience. Convenience is mobile phone because now so many payments are on the phone, and access, that people who don't have any access to the financial system or didn't now do. So payment systems have greatly improved, but it's with fintech and without blockchain. The only successful blockchain sortie there's been, sortie I mean a very small attack if you like, the only successful blockchain there's been in large-scale payment systems has been in cross-border payments. So here's what I'd like to do in the talk. I want to start by describing how traditional payment systems work. So let's begin again with my quick review of traditional payment systems. I'm going to talk about three things about traditional payment systems to make sure we understand. And this is true of many, many countries. I don't have to put labels for particular countries. There are two kinds of money. We're actually going to talk about a third later, but traditionally there are two kinds of money: central bank money and private bank money. So central bank money is cash, what you have stuff you have in your pocket, that's a liability of the central bank, and reserves at the central bank. So banks put deposits at the central bank, and that's also money. So banks accept reserves from another bank at the central bank. They accept that as payment. If one bank owes another bank payment, they do it by exchanging reserves at the central bank. So that's central bank money. Okay? These are liabilities of the central bank, and assets of the bank are reserves at the central bank. But we have another kind of money, which is private bank money. That's you have a deposit at a bank. If you're here, we have a brown depositor. That's a liability of the bank, an asset of the depositor. Why is that money? Because each depositor is willing to accept a bank deposit in payment. If someone owes you money, you're okay with having your deposits increased at the bank. Okay, so that's a second kind of money. You're okay accepting that as settlement. You're not okay accepting IOUs from your friends and neighbors. You want deposits. Just like that, the banks are not accepting other things from other banks. They will only accept money in central bank settlement. Okay, so something we're not conscious of, ultimate settlement is always in central bank money. So let me just give you a little application of that so you appreciate what's going on. Let's say a yellow depositor pays the blue depositor of the orange bank. So pays 10, whatever the unit of the currency is, from one to another. The ledger of the bank, the yellow depositor goes down 10, the blue depositor goes up 10. Nothing else happens. You accept that as money, the fact that you have more deposits. But there's nothing happening. No actual funds are moving anywhere. Nothing is happening in the central bank. So that's why I say bank money is its own kind of money. You accept it one to another. But on the other hand, what happens if we have a different transaction? You have the brown depositor sends money to the yellow depositor. That's across banks now. So the brown depositor, the money goes down at the ledger at the bank. The yellow, it goes up. But now the money has to move because the orange bank wants settlement, wants final settlement of that 10, and that happens in central bank money. That 10 of reserves moves from the green bank to the orange bank, okay? So again, we have two kinds of money currently in our systems, though lately we have another kind, but traditionally we've had two, private bank and central bank money, and ultimate settlement happens at the central bank. Okay? That's the first of 3 points I want to make on traditional payment systems. The second point I want to make is real-time gross settlement versus net batch settlement, or batch net settlement. By the way, you're going to be, a lot of people don't know these words. You're going to be super experts after this afternoon with these terms. So I'm going to talk about real-time gross settlement first. So let's have three payments First, Bank A pays Bank B 10. So it's now minus 10 cumulatively. Bank B has 10. Bank B pays Bank C 10. And then Bank C pays Bank A 10. So real-time gross settlement means as soon as this payment happens, the money moves. And it settles in central bank money like we talked about before. That happens right away. That's what I mean by real-time gross settlement. And then you can think about these 9 payments happening over the day sometime. So we had that first payment. Now we have a second payment. Now we have a third payment. Now you notice the payments that I've picked, they happen to net out, right? So everyone winds up net zero. A paid 10 but received 10. B received 10 but paid 10. And the same thing for C. So net, nothing has happened. Nothing needs to move. But this is a real-time gross settlement system. As soon as this payment came into the system, it had to be made. So even though everything nets out, to get this going, A needed 10 of liquidity reserves to do it. And that's going to be important. Real-time gross settlement, you've got to have money around in case you have to make a payment and you haven't yet received an offsetting payment. So let's do another set of payments. And this time, C's a little bit unlucky. C has to make a bunch of payments before it's receiving from other banks. So now, net, C owes 20. C has to have 20 in liquidity to get this going. And then finally, we'll have the rest of the payments. And they'll go back and forth, back and forth. And again, at the end, everyone winds up net zero. Everything's canceled out. But in order for this to have worked, A had to have 10 of reserves, liquidity reserves, and C had to have 20 of reserves. So in total, the system needed 30 of reserves, even though there are only 90 worth of payments. So real-time gross settlement is great because you get your money right away. And also it's great because there's no opportunity for some bank to owe a lot of money. Like it doesn't accumulate that C owes 10, 20, 30, 40, and then at the end of the day says, whoops, I don't have the money. Okay, here, if you default on one payment, everybody knows. So that's real-time gross settlement. Okay, what is batch net settlement? We don't do every transaction one at a time. We wait either until the end of the day or until a few hours go by, whatever. We wait, we batch payments. So let's say we wait to the end of the day, and then we have these 9 payments done. We see that, hey, everybody nets out, so there's no payments at the end of the day. We don't need anything in central bank money moving back and forth. Okay, that's net batch settlement. So just to review before I conclude this side, the advantage of real-time gross settlement is payment immediacy. Get your money right away. No risk of accumulating that someone owes a lot of money. Some big bank owes a lot of money throughout the day and then in the end can't make it. No risk of that. But the disadvantage is you have to hold a lot of liquidity to get this to work because you may have to make a lot of payments before you receive payments. Batch net settlement, the advantage is you need very few reserves because there's a lot of netting by the end of the day. In this particular example, you don't need any reserves for this to happen. But the disadvantage of batch net settlement is you have to wait to get your money. You don't get it right away. And you could have this risk accumulation. Now, before some developments that we'll talk about a little bit later, most payment systems in the world were a combination of real-time gross settlement and batch net. Real-time gross was used for large interbank payments. It's just too risky for big banks to wait for each other to pay, and then maybe they won't pay. So big interbank, large payment systems around the world have always been real-time gross settlement. All the rest of us, we have to wait. We have to wait for everything to go through the batch and to be net settled and then eventually get our money. Okay? So that's the second point I need to make about traditional payment systems. The third point is just how various businesses use these underlying payment systems to do their business. It's called rails because people like to think of money moving on a train over train rails. And that's a silly analogy because money only moves by ledgers moving around at various places. There's no moving of money by train, you know, but people say rails, which is you use the banking payment system rails. So let's just give you an example how a business uses rails. I'm going to talk about cards. You can be debit cards or credit cards. So the way that works is consumers and merchants initiate transactions. So I go to buy my coffee, I tap it. So we've initiated a transaction. The card network sends messages to the two banks, the bank of the card person, the bank of the store. The consumer account is debited, and then we wait for the interbank net settlement process to happen. Again, all settlement ultimately in central bank money, but we wait for all of that to happen, and then after that's done, the merchant account is credited. Okay? So again, I'm just making the point that a lot of payment systems that we have, businesses use the underlying payment systems of the banks. So this is real-time authorization, but the payment is delayed because it takes time and because of the net batch settlement feature. And I just want to say that all businesses add some value added. Here, the card network, you have the brand, so MasterCard and Visa tell you why those systems are so great and you should use them. They set the rules of engagement between the merchants and the cardholders. They guarantee payments to the merchant. They say, hey, if you have a dispute, how do we solve that? And they tell you who's responsible of this fraud. So if you have a business, and we'll see a few examples of this, you have a business, you're going to do some value add over these bank rails. And if we go back to like 2009, I'm going to give some data for the US, but I think it's similar in a lot of places. There were a lot of opportunities for improvement with respect to speed, convenience, and access. So with respect to speed, at least about that time, payments usually took between 1 and 3 days. Probably today, using traditional payments, it's 0 to 2 days, but it's a while. Some payments take a lot of time. Also, some systems just stop at 3 in the afternoon, right? So if you make a payment later, you're out of luck. You have to wait till the next day. On weekends and holidays, everything stops, so you can't make a payment. But there is growing demand for more immediacy in payments. Particularly, there are a lot of households that would like money sooner so they can make payments that they need. There are businesses that really can't. They need to buy goods to sell them, and when they sell them, they need to be paid right away to buy more goods. So there's demand for much faster payments. I give some other examples here. So there's been a move in the world to what we call real-time retail payment systems through Fintech, a lot of Fintech developments, and I'll be talking about that in detail in just a little bit. The second area needed for improvement is convenience. So go back 15, 20 years, you interacted with a bank by going to a bank or by making a phone call, and that's not nearly as convenient as using your phone to do everything, of course. If you had to write checks or use cash, that's quite cumbersome. So there's been a general move through Fintech to do all payments through mobile. And that includes using QR codes by merchants, which is terrific because you don't have to give them any information about your bank account. You just look at the QR code and then send it through the system along the lines we've been talking about. So convenience is the second one, and access. So in many developing countries, a lot of individuals don't have a bank account. If developed countries have a little bit of the problem, but in some countries it's very big. And if you don't have a bank account, you're really cut out of the payment system. It's very difficult to participate. And businesses also, by the way, those card readers that we take for granted, that's expensive for a lot of businesses. And processing cash is also expensive. And the reason why we care about this as a society, limited access to payment systems means limited access to credit. So if you aren't participating in the payment system, it's very unlikely as an individual or as a business you can borrow money, and you can't grow and you can't improve your condition. The other thing that's fighting against access is all of the government rules to prevent money being used for illegal activities, for terrorism, et cetera. We call those know your customer, anti-money laundering rules, privacy. Of course, the government makes sure everyone pays their taxes. So all of these things actually fight a little bit against access. Because if you make it too easy, it's also easy for people who are operating outside the legal system. So this has kind of been solved, as we'll see, by light bank accounts, meaning you sacrifice a little bit of this, but also you offer bank accounts that have relatively few services compared to more complex bank accounts. But again, I'm going to give you a detailed example of all these three as we go on. One last thing is that cross-border, all of these things have been even worse, and I'll come back to that later. So now I'm going to talk about how Fintech has upgraded payment systems dramatically. So the first example I'm going to do is what I call these real-time retail payment systems. So the poster child of this has been India's UPI, United Payments Interface. So even though I'm going to focus on the speed, it's actually that this system helped a lot also with respect to convenience and access. So basically, India had a national electronic ID system and ways for people to send data to whoever they needed to set up an application for. So it was very easy to get set up to do financial transactions. All accounts were linked to mobile phone numbers. So you didn't need all your bank accounts and your routing numbers and all those things. You just had your phone number. Businesses can use QR codes. I mentioned that before. And very importantly, it's always, competition works. right? So very importantly, they said, okay, we're making this system that people can send money through their mobile phones, but anyone has to be, not anyone, any company can create an app that links into this system, as opposed to just the banks doing it and you've got this clunky thing and you can't use it and there's no competition forcing better provision of services. So, the system forced the competition. Anyone can set up an app on top of the system. So the big ones now are PhonePay, GPay, Amazon Pay, et cetera. So anyway, that's the convenience part, but I want to focus on the real time. So what this system does is if you send a payment peer-to-peer or business to, peer-to-business, business-to-business, you're credited right away. Okay. Now, but it happens though that world, real-time retail payment is actually a lie because the money is not actually going right from you to you. It's actually being settled net batch, like we talked about before. So the banks that is crediting the person who's getting the money is taking some risk. The banking system is taking some risk that the payments are going to come in and ultimately made. And that has to be managed by the central bank, that risk. But so it's fine that we all call it real-time retail payments, but we have to have in mind that was actually done by creating a financial system that we actually use net batch, but people perceive it as real-time gross. Isn't it great we can use these fancy words that we just learned? So then there's also access. Again, this is not my main point here, but I'll spend a minute on it. Banks were forced to offer very basic, simple accounts that linked up to UPI. So that means many, many people had more access to bank accounts and to the payment system than ever before. And they set up ways that you could put cash into the UPI system and take cash out. And I won't go into the details of that right now. Now, more than 70 countries now have real-time retail payment systems. They developed mostly, the urgency was in countries that had mostly cash, very little access, people having very little access to payment systems, no credit availability for a lot of people. So the 5 biggest, India, Bahrain, Thailand, Argentina, Nigeria. So those are the biggest. Now, don't mix up real-time payments with sophistication because, like, for example, Korea has like 90% electronic transactions, but not so much real-time because they didn't have the urgency that these other countries had. Similarly, the United States has not quite as much, but in the 80s, electronic transactions, but almost no real-time retail payment systems. So all countries are moving that way, but the countries that had the worst situation as far as access to the financial systems, credit availability, et cetera, were the ones to have really pushed the envelope on doing real-time payment systems quickly. Okay, so now I want to focus on convenience. And for this, I'm going to give example of Square, which is that's a US company that provided merchant services. Square was the first one to come up with these little readers that you're used to having into stores. So even if you weren't a big store, you didn't have this big cash register, all you needed was this tiny little device and you could accept card payments. So they were the first ones that came out in 2009, the same year as the first trade of Bitcoin, right? So things were already moving along in the fintech space. And I just want to point out here that it was an entire suite of services. Again, blockchain promised to do boom, one payment from one person to another. But to get this to be successful, look at all of these other things they did. They had to come up with the hardware. They did payments processing, and they did it a little bit faster than traditional payment systems. They did point-of-service software. So if you're a business and you're getting payments, this software around that enabled you to manage inventory, to contact customers, even to pay your employees. So there was a whole suite of services around the payments. So it wasn't just sending money quickly to one person to another that would make a huge improvements in payment systems. Integration of e-commerce. So their software products allowed you also to accept payments online, and if you had an e-store, to manage that. So all those suite of services being done. They also offered banking products. So you can, once in Square, you could have a checking account, a debit card linked to your Square account, savings account. And this is a brilliant thing which has happened. I'll talk more on the next slide as well. Once all the payments are in this system, the Square can say, oh, I see how much money you're getting. I'm willing to make you a loan because I know what your revenue is. Okay, and I'll speak more about that. But that's a great application of fintech to financing, that when you have all that data, And we're always worried about giving up our data, but this is a great use of giving up your data, right? Everyone sees the money you're making and say, oh, I'll make you a loan now because I see what your business is like. Square is a money transmitter. So Square is not a bank. In the US, it's called a money transmitter. And it holds customer funds in a segregated omnibus account. What do I mean by that? It's segregated from Square's money. So Square has money as a corporation. All customer money is held separately. You'd expect that. But all of customer money is held in just one big account. Square doesn't have a bank account for every single Square customer. It has one big omnibus account. And other fintechs work this way as well. Alipay, WeChat, Pay, Paytm, PayPal, they all work this way as well. Now, I want to say this is really quite remarkable. That is a third kind of money. Why do I say that? Imagine one Square customer paying another Square customer. Nothing has to happen. Just like in my first example, if a depositor at the Orange Bank pays another depositor at the Orange Bank, nothing moves. It's just a ledger on the bank, at the bank's thing. Similarly, this is just a ledger in Square because people are willing, to some extent, not as much as banks, but to some extent, they're willing to accept their Square money as payment. Now, do we care about that? Well, it's interesting. One of the reasons that the banking system is so heavily regulated is we're worried about the payment system falling apart. We're worried if some banks fail, then no one can do any transactions. But here we now are starting with a lot of these kind of companies, essentially, being another kind of money and not regulated anyway the same way the banks are regulated. So something to think about. I'm not going to spend more time on that in this talk. Now I want to focus on access, and I'm going to focus on Kenya's M-Pesa system. So what happened is Safaricom was the by far dominant mobile phone provider in Kenya. And they said, you know what, we've got basically everyone is our customer. Everyone, phones are very common, everyone is our customer. Let's use our phone system to create a money transfer service. So they did that. You could basically put e-money on your SIM card, and then you could make payments for goods and services. So kind of all of a sudden, everyone is now, connected. Anyone on a phone was connected to the payment system. And they already had an existing extensive network of agents to do the phone services, and those people converted cash into e-money and back. So anyone could easily put money on their SIM card and take money off. And once again, cash is held in omnibus trust accounts. So again, no individual bank accounts for all these millions of people who are using it. One account for all of the customers. Banks originally didn't like this. They thought it was going to hurt their businesses, but they eventually, it became so popular that they joined in, and they offered very simple bank accounts that could connect to the M-Pesa system. There are also these M-Shwari savings accounts, which you can make loans, again, based on the transaction and savings history. So they see what a person has done. It could be the standard example, the amazing example is someone who sells goods at a farm, at a market. So they could basically get a loan in the morning and then sell their goods and pay off the loan. And they can do that because the system sees what they've done every day or every year or whatever. So they can say, this person, even though they're not connected to the financial system at all, actually has the resources to pay off this loan. So you make loans to people who have never gotten loans before. So microcredit, that means a small loan, anytime, anywhere. And actually you can repay. So it could be that when you get money, it'll actually take it right out and repay. Now, I just want to spend 1 second on the grander theoretical picture here. Development economists say one reason that developing countries have such a hard time is people have no collateral to borrow against. So you can never get your life going because you never have anything you can put up to borrow money to start somewhere. And here, your credit history, just the history of making money every day, a small amount, is enough. It substitutes, instead of collateral, that you can borrow money. You could also say a savings plan, so you don't trust yourself, you can force the phone, hey, you're going to take away this much from my account, put it in a savings account, and I can't touch that for 3 months. So it has that kind of functionality as well. So I just want to point out, this has been a little tricky for regulatory purposes because you made it so easy to get accounts to put money on your phone, and people have criticized the system that it allowed illegal types to use the system as well. But I think the correct answer, which was given by a central bank governor in Kenya, he said, well, listen, that's better than the cash system and the informal financial system that existed before. So we have to put up with a little leakage if we want to make progress. Just some numbers about the amazing change this has done in access. So from 2006, only 27% of the population had access to formal financial services. By 2019, 83%. 2006, 41% of the population was completely excluded from financial services. That went down to 11% in 2019. So there's been a remarkable success as far as access goes. Okay, now I want to come back to cross-border payments as I described in the outline. So first of all, why cross payments so difficult in the traditional system? So say we want to send some money from Boise, Idaho to, I'm going to pronounce it wrong, Buchan, right? So we want to send money from there to there. How is that going to work in traditional payment systems? Well, first, the payer has to send to its bank, has to put the money into its bank. Secondly, the money has to move to an international correspondent bank. I'll explain what I mean by correspondent bank in just 1 minute. When the money is at the correspondent bank, then it will engage an FX trader, a foreign exchange trader, to sell US dollars and buy Korean won. Okay, and I had that done in Incheon, where we are now. And then that money is deposited into the US correspondent's bank account at the Korean correspondent bank account. So that's why they're called correspondent banks, because each has an account at the other. So in other words, remember, you can only trade US dollars in the US system, and you can only trade won in the Korean system. So the US bank has a won account at its international correspondent in Korea. So once again, this money comes here, there's an FX trade, the won is deposited in that bank, in this bank's account, in the correspondent bank. From there, it goes to the payee's bank, and then finally, the money gets to the payee. So you should be thinking to yourselves, that's a lot of steps. And in a financial system, every step, somebody gets paid, right? No one's doing any of this, there's not volunteer work, right? Everyone's getting paid all along the way. So this can get quite expensive. And when you think about it, we say, you know, it's not surprising that this is hard. Every country has its own payment system, its own set of regulations for banks and how payments are made, its own way data is stored, its own technological systems. It's no surprise, if you think about it, that this is so hard to do. And there are a lot of leaks. So bankers still say, by the way, this stuff is all of 2024. So not even of 2009, even of today, this system is still very difficult. So this is a quote from a JP Morgan Chase publication. A lot of time is spent just chasing around money that was supposed to be in one place and isn't there, okay? Because it's still a very creaky system. Just to give you, to emphasize how tough this is, if you look at costs, 37%, only 37% of these international transactions have a cost less than 5%. 45% have costs between 5 and 10%. That's a lot of money. Between 100, if you send 100, that means it costs between 5 and 10 for 45% of the transactions. And there are some that cost a lot more, 10% between 10 and 15. Okay, so the cost is still extremely high today. And also, if you look at how long it takes, this is globally. You can get this data broken down if you use by a bank or mobile operator or a money transfer person. But if you look just globally, yeah, there is a decent chunk. Digital means everything is digital. Cash means there was some email or some phone call or somewhere along the line. But a decent chunk takes less than an hour. But and some stuff is same day, but plenty of stuff takes next day, and a lot of stuff takes more than 1 day to be transferred. If you go through the banking system, a lot of it is more than 1 day. Okay? So traditional payment systems have done worse this cross-border, but perhaps not that surprising. So now let me go through some upgrades of cross-border systems. We'll do first one, fintech without blockchain, and then we'll finally get to some place that blockchain is being used in the system. So here's a company called Wise. Wise was created in 2011 by 2 people from Estonia who were just disgusted, or exasperated, by costs of moving funds between where they were living in the UK and Estonia. So they created this system, and how does it work? They have, again, these omnibus, that's a great word, by the way, it's very useful in finance, omnibus account. So no, you don't have individual accounts. You know, if you're a Wise customer in the US, your money goes into this one large account. So they have a US dollar Wise account, and they have a Korean won Wise account. So if I'm a Wise customer, I will look at my accounts, and I'll see, oh, right now I have 100 in my US dollars, and I have 0 won. And now let's say I want to make a payment in Korea. So I will take 10 away from my US dollar, I'll convert that to whatever the exchange is. So now I have that yuan, and then I'll use my Wise debit card, or I'll wire it out, or I'll do something from there. So that's like really fast. All I do is on my phone, I move the money. Okay. But of course, stuff has to happen there, right? Because if I do this, then the amounts in these accounts don't exactly correspond anymore to what the customers hold. If I do this, nothing yet has moved here. I now have more yuan here than I did before, but nothing has happened there. So Wise needs to manage that, right? So it manages that either by actually doing FX transactions, or just hedging, or holding reserves, or even by changing its fees and spreads to attract transactions in the opposite direction, so it stays balanced. They've also, by the way, have had compliance issues, because you're, again, going across jurisdictions with different rules, and they've had some issues, and they've been working to clean that up. But anyway, so this was a terrific solution to the international payment issues just using fintech. Okay, so finally now, blockchain has been used also, finally, in this situation. Again, it hasn't been used in large magnitude in any of the other things that I talked about, except perhaps illegally, which, again, we don't have that much data about. But it has been used here in Ripple and JPM Coin. So just, I'm sure this audience, if you've come here, I'm sure you know what blockchain is. But for this talk, we'll just say it's a ledger. It keeps track of who owns a certain token. And you could just transfer ownership very quickly of a token from one person to another on the blockchain. And that happens instantaneously. Okay? So that's all I'll say for blockchain now. So I'm going to give two examples. One is Ripple and one is JPM Coin. So I'll talk about the differences in a minute. But the way it works is incredibly simple, right? It's that if you're US dollars, and again, I want to send money from the US to Korea. So all I do is I sell my US dollars and I buy a token. I'm going to talk about the two different kinds of tokens in a minute. But I sell my US dollar and I buy a token on a blockchain. And then all you do is you switch on the blockchain, you switch the ownership to the person that's supposed to get it. And that person sells the token for yuan, okay? So that's, whoa, that sounds like, whoa, that's so fast compared to when I showed you all those arrows before. Okay, so let me just talk though, it's not quite as easy as it sounds. Let me just describe why. So Ripple is one company that's been doing this since 2012. Its token is called XRP. So Bitcoin is one thing that trades on a blockchain. You can have other things trading on blockchain, the tokens, and that's XRP. And this is public permissionless. So anyone that follows the rules can kind of join and participate in this blockchain. It's open and public, okay? So the way the system works is if I want to send this money, I will look in Ripple's system and look for someone to quote me a price for essentially changing my dollars into yuan. If I find something that I like, I will do this transaction. So this depends on what Ripple calls its on-demand liquidity system. And then if it works in seconds. But I just want to point out what it's depending on. Like the blockchain dream is to have no financial intermediaries, but you're depending on someone willing to buy your dollars and sell you the token, and then on the other side to buy your token and give you yuan. So you're relying on a set of market participants, so maybe it's not exactly the same as a bank, but it's similar, right? So you're relying on market liquidity to get this to work. The other kind of way this is being done, it was JP Morgan Coin, for example. This is 2020. So this is not the blockchain dream. It's not public, anyone can participate. The only people who can play in this playground is JP Morgan and its clients, okay? But they have their own coin. Now this is not a token. This is what's called a stablecoin. So it's backed fully by US dollars. So stablecoin means backed by a fiat currency. So in this case, US dollars. And then it works the same way, but it's only for JPM and its clients, and it's the stable coin. But I think this is an incredibly important step in blockchain because now you have a super serious player. I mean, talking about JP Morgan Chase, the largest bank in the United States, that's now saying, we can make payments more efficient by using blockchain in this way. So to conclude, blockchain, this idea of just changing the token from one owner to another, that's naturally suited for real-time gross settlements, right? When I said you just send money from one to another, that's real-time gross settlement. Blockchain also, by the way, does smart contracts, so you can make it conditional. Send this if this happens. But if we look at the history of the last 15 years of what fintech has done and how it's improved payment systems, look at all of the things that had to happen for payment systems to be significantly improved. We needed all the hardware. We needed an ID system, so that people could easily, say who they were electronically. We had to get ways to connect the unbanked to the financial system. We had to have this software added. It wasn't just enough to say someone, I'll send a payment for you, but we're going to have tracking and budgeting and analytics and whatever else you want to connect it with your payments. We've had this brilliant thing of smart lending, that you use the data to make loans, which is going to make people use these payment systems more. We've had this dispute resolution, and then these omnibus accounts and netting, which is, again, quite different from what blockchain envisioned, right? When blockchain says send it from one person to another, the idea of keeping everyone's money in one omnibus account is quite alien to that, right? So I think what we have to think about in the future is, can blockchain grow using all of these foundations? In other words, blockchain needs to get rid of the dream a little bit of the 2009 quote that I gave you, 2008 quote that I gave you, that it's only going to do real-time payments. It's got to encompass all of these things that have to happen. And the only comment I would add to that is, this omnibus account and netting seem a little harder in blockchain, right? If you remember, this omnibus account, to get that to work, you need the banks to sort of agree, on how it's going to be a safe system, et cetera. And netting, so yeah, you could do it in a layer 2 blockchain with smart contracts, but it's not that natural, again, because blockchain is naturally just real-time gross payments. So I think some of the purity of philosophy is going to have to go away to use blockchain just as a technology along with all of these things alongside it. All right, we'll conclude then. Thank you very much.